Real Estate Capital Scoreboard January 2013 January 2, 2013. Chicago, Illinois, January 2, 2013. The new year is a welcome sign to real estate investors looking to borrow money in the coming months. Even as Treasury rates rise, lenders aggressively compete for qualified mortgage funding possibilities. Spreads over Treasuries tighten as more sources jump into the capital market fray. Cautious optimism fuels lending activities, with overall underwriting discipline still observed, along with the following key trends in the annual Realty Capital Market Forecast for 2013. Steady rates. Without sounding repetitive, short-term interest rates are expected to be somewhat flat as the Fed steers a straight rate course for the next few years. But longer-term rates will be fickle, riding the wave of inflation. In fact, a 2% to 2.25% Treasury rate would not be a shocking figure. Balanced commercial property markets. Watch for a better mix of economic performance for apartment, retail, office, lodging and industrial properties. During the past 5 years, multifamily properties had a lopsided advantage over other commercial properties as oversupply and weak job growth plagued other assets types to a greater extent. This year, home ownership is again on the rise, with the number of households expected to double in comparison to the past decade. Furthermore, other property types are in tight supply with steadily improving cash flow. The net result? Multifamily ownership is no longer the clearest commercial property investment option. Construction funds with more dollars. As commercial market fundamentals are slowly improving in most markets around the country, funding sources are providing fuller leverage loans, now reaching 70% to 75% based upon costs. The project exit strategy must be provable within a term of up to 3 years to compete the construction or renovation. Floating rate pricing falls within a range of 225 to 325 bits per second over LIBOR. Cash outs. Yes, cash outs above existing debt, and even investor total cost levels, are more acceptable for top-tier projects and owners. Why? Lenders need to capture more yield by climbing the risk ladder. That said, cash flow characteristics must be strong, along with underwriting benchmarks such as debt yields, LTVs, etc. Pricing premiums of 25 to 50 bits per second are common versus standard pricing. Higher leverage via mezzanine, or BP's debt. Numerous fund lenders and even a few life insurance companies have made higher leverage, up to 75% to 85% LTVs on future value, in mezz financing over the first mortgage for properties with upside to be captured down the road. These sources have viewed this debt as an advantage to capture future solid real estate performing properties. Risk sharing. As institutional lenders compete for larger deals, club deals are back again. Typically $50 million or larger. Such loans comprise a syndicate of various lenders pooling funds together to invest in larger loans. These club loans are often formulated based upon a pari passu formula of proportional risk and profit sharing. Generally speaking, pool participants seek 25% or less exposure in any given pool, to help with loan diversification guidelines. The Real Estate Capital Institute's research director, Gene Peck, predicts, a recovering economy is a two-edged sword for the mortgage markets. Higher performance at the cost of higher rates. The right balance of cash flow, mortgage rates and leverage is always a fragile mix.
February 4, 2013. Real Estate Capital Scoreboard February 2013. Chicago, Illinois, February 4, 2013. Low interest rates continue driving realty investments and profits on both Wall Street and Main Street. Investors flock to this sector, enhanced by a record-right profits and the tightest supply of U.S. existing for-sale homes inventory not seen for over a decade. Benchmark yield changes and improving loan volume estimates for 2013 are the other major realty finance market news stories this month. Benchmark yields. Treasury rates crept up by the end of the month, with the 10-year note hitting the 2% mark, the highest since last March. Mounting rate uncertainty plagues that markets as lawmakers struggle to agree on the U.S. debt ceiling. Many analysts believe that rates may reach up to 2.25% by year-end. Loan volume estimates. Wall Street, agencies and life companies are bullish for 2013. As BP's investors return, conduits expect to regain market share. CMBS lenders target about $65 billion in new production, about a third increase in volume from the previous year. Agencies nearly doubled their funding volumes in 2012 to about $60 billion, but few believe such performance levels are sustainable because of heightened competition from other sources. Life companies will keep their slice of the debt investment pie, hoping to top last year's $45 billion threshold. Lastly, banks now have cleaner and leaner balance sheets. Banks traditionally account for about half of all funding volume. In particular, regional banks will re-emerge as the wild card players looking to expand market share. Pricing differentials: despite select lenders raising spreads, fierce competition drives very attractive spread, negating any really meaningful pricing increase. If anything, the pricing arrows point down. For 10-year debt, the best pricing spreads start at 160 BP for 55% LTV or less leverage. Add an additional 15 bits per second to move up to 65% LTV and another 15 bits per second to reach full leverage at 75% to 80%. The difference between 5 and 10-year term loans equates to 25 to 40 BP higher spreads, but the Treasury notes are nearly 100 BP lower. The net result of 5 versus 10-year terms translates to at least half-point lower rates. Ms. Jean Peck of the Real Estate Capital Institute emphasizes the mix of a recovering real estate market with an oversupply of capital leads to an exciting path of capital creativity. We expect that more new ideas and programs will emerge throughout the year. March 1, 2013 Real Estate Capital Scoreboard March 2013. Chicago, Illinois, March 1, 2013. The shortest month of the year closed with overall improved real estate capital market conditions, at least for borrowers seeking debt. Treasuries dropped about 15 basis points and mortgage spreads compressed, resulting in nearly 25 basis points lower rates. Renewed fierce competition among funding sources negates any clear differentiation between various types of lenders today. Banks, life companies, Wall Street, agencies and private capital sources are all bidding within very tight underwriting ranges for higher quality assets and creating new lending programs to fit almost every client preference. Floating rate loans enjoy historically low pricing and benchmark LIBOR and bank prime rates remain flat for more than a year. That said, any meaningful pricing discussions are within the realm of the fixed rate debt. Based upon term, current pricing ranges for multifamily, office, retail and industrial properties requiring fixed-rate debt and assuming typical leverage levels of much as 75% are as follows. 5-year term, 2.75% to 3.5%, with banks prevailing in this term. Oftentimes, such loans are structured using swap contracts. 10-year term, 3.75% to 4.5% with life companies and conduits leading the pack. Select banks offer such terms to preferred customers. Agencies still lead the market for apartment deals. With so much competition on pricing at levels many funding sources find unprofitable, the capital markets are re-evaluating risk spectrums. In search of yield, more lenders find themselves targeting secondary markets, higher leverage and non-traditional property types. For example, an unflagged hotel in a secondary market will be priced at least 75 to 100 basis points than typical loans. All in all, such risk premiums are far much more compressed than in any time since the Great Recession when pricing was double to triple of today's levels. In fact, even high-risk, short-term situational debt yields are moving into the higher single-digit yield range in many cases. The Real Estate Institute's Jean Peck notes, with the economy skirting a contraction in December 2012, improving economic conditions and limited new supply, especially in the non-multifamily property sectors, lenders feel more comfortable with risk today. Many are clearly willing to widen risk tolerances to snag more yield.
April 2, 2013. Real Estate Capital Scoreboard-April, 2013. Chicago, Illinois, April 2, 2013. Once again, the Eurozone is in the spotlight with Cyprus in center stage. This time around, the stock market hit record highs and the bond markets reacted calmly. Investors are becoming more accustomed to such news. Therefore, overall treasury rates remain somewhat flat with mortgage markets continuously enjoying record low rates. All in all, 5-year fixed-rate debt is priced in the 2.5% to 3.5% range with 10-year debt priced approximately 1% more. The only other news on the permanent loan front is the FHA/HUD. This agency's rates are now more in line with conventional mortgage markets. The program still remains attractive though, due to the longer-term and non-recourse, new construction funding program options. In addition to senior debt discussions, mezzanine and preferred equity funding sources continue to tighten pricing. Loans up to 75% leverage are priced in the single-digit range. For aggressive, higher leverage debt of up to 90% of the capital stack, lower to mid-teens is now the new benchmark. The sources of funds find themselves aggressively competing with cheaper equity capital. Everyone is scrambling to find attractive realty investment opportunities in various parts of the capital stack. CMBS lenders continue to fill their higher goals for 2013 by tightening spreads and actively quoting smaller loans, although few will be interested in loan sizes less than $5 million. Priced over swap rates rather than treasuries, their quotes have been competitive with more traditional sources for certain properties. Lastly, a select group of life companies are returning to the market with competitive participating loan programs. These funding sources offer construction/perm product for to-be-built multifamily projects with up to 90% leverage on cost, accruing coupon rates of 4.5% and more. In return, they receive a participation of cash flow and reversionary profits, usually just below 50%. According to Gene Peck of the Real Estate Capital Institute, lenders are opening their wallets wider than ever before. Nearly everyone is in the fray for originating loans, and it's difficult to discern which capital player is a best match for what type of deal. May 1, 2013. Real Estate Capital Scoreboard-May, 2013. Chicago, Illinois, May 1, 2013. History was made last month with treasuries hitting an all-time low for the past 2 centuries. Can rates go any lower? This is the question that everyone seems to be asking. In comparison to this year's previous low, treasuries are about 20 basis points lower for the 10-year term and about 10 basis points lower for the 5-year term. The 5 and 10-year treasuries continue floating about 100 basis points apart. Yet if historical mortgage spreads are any indication of the future, mortgage rates may still drop slightly lower, by 20 to 30 basis points, within the normal range of 120 to 150 basis points over comparable term treasuries. Given today's rates, the possibility of lower 3% fixed-rate debt for 10-year loans is not remote. This type of pricing is so low, substantially narrowing the gap between fixed and floating rate debt. With such tight mortgage pricing grids, lender differentiation turns from pricing towards other variables including prepayment flexibility, guarantee carve-outs, liquidity covenants and allowance of additional debt as examples. If at all possible, lenders are trying to remain disciplined in underwriting by keeping loan proceeds at conservative levels, although this underwriting variable is also being aggressively stressed. According to Gene Peck, director of the Real Estate Capital Institute, mortgage pricing is becoming more negligible as a negotiation variable, given that the actual rates are extremely low. She adds, where do we go from here? Nearly everyone expects rates to rise sometime in the next 18 to 36 months, but mortgage pricing does not reflect such thinking.
June 3, 2013. Real Estate Capital Scoreboard-June, 2013. Chicago, Illinois, June 3, 2013. As the Dow broke a new record plowing through the 15,000 mark, the economy certainly shows renewed signs of life, with the commercial realty sector as one of the main benefactors. Nearly everyone's feeling better about the commercial markets, although many remain guardedly optimistic about the recovery's strength. Real estate capital market focal points include: benchmark indices. As expected, improving bull markets helped push interest rates to higher levels. By Memorial Day, 10-year treasuries broke through the 2% barrier, not seen in more than a year. 5-year treasuries also bounced upward, but remain below 1%. LIBOR and prime stay unchanged. Cap rates. 5% to 6% cap rates reflect credit-tenant properties with longer leases of 10 years or more. More typical urban properties comfortably trade below 7%, while suburban assets and tertiary market properties approach 8% or more. Yield creep continues as the supply of high quality remains limited for commercial properties, forcing buyers to search for deals in secondary locations with riskier cash flows. Mortgage rates. Performing commercial properties are in strong demand by lenders. Based upon 10-year permanent loans, mortgage spreads are in the 180 to 250 basis point range over treasuries, translating to interest rates of approximately 3.75% to 4.5%, still extremely low by any historical standards. Select retail, industrial and office properties start at about 15 to 20 basis points more than multifamily assets. Leverage. Due to the highly competitive costs of equity, many investors are comfortable with 65% to 75% debt level in exchange for low interest rates with prepayment flexibility. New construction. With pricing peaking in nearly all commercial property sectors, often approaching replacement cost levels, developers and tenants find new construction more appealing. In particular, tenants are driven to high-density urban areas near public transportation. Automobile parking lots are shrinking, while bicycle racks grow. Gene Peck, the Real Estate Capital Institute's director, Gene Peck, insists, it's an outstanding time to be a seller and an equally tough time to be a buyer. Core and core plus assets are priced to perfection, driven by frightfully low interest rates. July 1, 2013. Real Estate Capital Scoreboard-July, 2013. Chicago, Illinois, July 1, 2013. What a difference a month can make, as short and longer-term treasuries skyrocketed by a half a point, throwing the real estate capital markets into a tailspin. Instant reaction varied from pulling out of the market to directly passing through interest rates to borrowers. In reality, most funding sources chose a path somewhere in between, including structuring the following underwriting solutions. Rate lock deals closed without any fanfare, while loans under application, but without rate locks, were adjusted by 10 to 25 basis points, depending upon the specific terms and conditions. Many lenders tried to absorb about half or less of the rate increases to show good faith to their clients. Except for very highly leveraged loans, most funding sources made every effort to keep loan proceeds that same, despite more stressed underwriting. Debt service coverage almost instantly became the most important loan sizing benchmark, as increased rates quickly surpassed loan-to-value and debt yield thresholds. Today, 125% debt coverage is most common value, but exceptions are made for existing loans already in play. Rate floors are increasingly popular. For example, 4% for 10-year loan. However, most lenders start loan discussions at rates in the mid-4% range, given current mortgage spreads, mostly unchanged. Forward delivery rate locks beyond 90 days are mostly on hold as lenders wait for more market clarity. Floating rate debt is generally unaffected, as witnessed by flat LIBOR pricing. Gene Peck, director of the Real Estate Capital Institute, emphasizes, the dramatic widening of interest rates clearly illustrates the differences between various types of lenders, namely life companies, banks and Wall Street. She adds, Wall Street responds instantly, while life companies and banks try to absorb some of the volatility. Chase quality. Banks chase customer relationship and balance sheets.
August 1, 2013. Real Estate Capital Scoreboard August 2013. Chicago, Illinois, August 1, 2013. Another month of Fed watching that has now become America's favorite spectator sport. The capital markets try to guess how the balance of Fed monetary policy weighs in for driving interest rates and economic growth. And watchers have not been disappointed with the action. After Independence Day, rates jumped up by 15 basis points as investors nervously reacted to Fed comments about maintaining low interest rates. However, the dust settled with rates landing near the same levels of June. Some lenders refrained from quoting deals for a few weeks. They are back in the market, some quoting shorter terms, 5 to 7 years, where they had been quoting longer term before. Bridge lenders and banks enjoyed increased attention given their LIBOR-based programs remained unaffected by the Treasury volatility. As for longer-term trends, lenders, especially agencies, are modestly widening mortgage spreads in anticipation of higher rates given 3 consecutive months of rising rates. Today mortgage rates are about 5 to 10 basis points higher. Lenders quote longer-term loans at 180 basis points over comparable term treasuries for 10-year deals and well over 200 basis points for high-leverage debt. Meanwhile, conduits are tightening pricing due to increased competition on Wall Street, the banks and life companies, in general. Furthermore, investors are snapping up fresh CMBS bonds, creating more optimism for this sector. In the aftermath of rising rates, debt service coverage is the de facto underwriting metric for loan sizing. Other criteria, namely loan-to-value, are less applicable with property value decreases not directly matching higher mortgage rates. Coverage of 125% is the standard for most loans, with 101% offered for credit deals and 140% or more for lodging assets. Should mortgage rates remain at current levels for a sustained period of time, expect values to adjust downward with LTV ratios returning to prominence. According to Gene Peck of the Real Estate Capital Institute, sudden rate jolt fears have quelled, but everyone seems to be worrying about rising interest rates, particularly for 2014 and beyond. She adds, "It's not a matter of rising rates, it's a matter of when rates will rise." September 3, 2013. Real Estate Capital Scoreboard September 2013. Chicago, Illinois, September 3, 2013. The seesaw battle between inflation fears and lagging economic growth reflected the investor fears of August. The last full month of summer witnessed rates steadily rise by more than 25 basis points for 5-year maturities as investors try to tackle uncertainty based upon Fed policy. Even as interest rates moved upward during the past few weeks, most lenders have held mortgage spreads unchanged. Permanent mortgage rates for 10-year or longer debt are hovering in the 4.75% to 5.25% for most property types. Shorter-term debt is readily available at 4% or below for the most part. With another round of mortgage rate hikes, borrowers feel pressured to lock into fixed-rate debt. On the other hand, lenders are trying to carefully match optimal rates with the proper yield profile as not to have too much long-term debt exposure, should rates continue rising. Given such capital market conditions, expect more equity/participating debt programs to emerge as lenders look for rate protection. Commercial property markets recovery is choppy, with major coastal and energy-related markets enjoying stronger results. In the commercial property markets, many businesses feel better about the economy. As such, tenants are starting to sign longer-term leases, and landlords report improving cash flow, especially in the industrial and retail sectors. Multifamily properties and hotels continue to enjoy better performance, but owners worry about rising expenses, especially from real estate taxes. The Real Estate Capital Institute's Gene Peck suggests, the remainder of the year will be more challenging as investors realize that rates have hit bottom and are now on a rising trajectory. She concludes, rising rates are not necessarily bad, if accompanied by stronger economic growth for better cash flow performance. October 1, 2013. Real Estate Capital Scoreboard October 2013. Chicago, Illinois, October 1, 2013. September has been a quiet month as mortgage spreads remain unchanged and lenders continue seeking high-quality funding opportunities. All in all, overall longer-term mortgage rates moved about 20 basis points downward during the month. In general terms, the most common commercial properties are enjoying a continued resurgence in demand by lenders and investors based upon the following highlights. Multifamily. Over the past 5 years, the sharp decline in home ownership rate has propelled multifamily demand to record heights. With home ownership rates at about 65% for all households, nearly 5 million more renters are in the market. The U.S. Census Bureau shows more job creations in costly dense urban areas, helping spur more demand for rental housing. Lastly, rising interest rates keep renters in place for longer terms as recovering housing prices prove too costly. Office. Downtown core office buildings are trading for record prices, even higher than the recession, as foreign investors and domestic pension funds compete for a scarcity of products. On the other hand, suburban office buildings are starting to show life, although rental rate increases are far out of reach, as expenses and real estate taxes escalate faster than rents. Industrial. The improving economy is directly benefiting this sector, as more developers are starting to build spec projects that are successfully leased upon completion. This sector enjoys steady growth as newer space replaces obsolete industrial/warehouse facilities in many markets. Retail. Urban infill are the two words to remember for retail. Tenants are learning to reconfigure space into tighter sites with limited parking, in exchange for greater density and access to mass transit. Grocery-anchored centers and fortress malls are the most desirable properties, also trading at record-high premiums. Property-type mortgage loan spreads. Mortgage spreads over 10-year Treasury notes are within a reasonably tight range for most types of Class A commercial properties. Such spreads start at 175 basis points for office properties, varying about 15 basis points lower for retail/industrial properties and as much as 20 basis points lower for multifamily assets. Gene Peck, the director of the Real Estate Capital Institute, advises with tightening mortgage spreads between various property types, lenders continue scrambling for high-quality assets in all commercial property categories. The Great Recession created a pent-up demand for core assets, which remains the biggest challenge for the real estate capital markets to solve. November 1, 2013. Real Estate Capital Scoreboard November 2013. Chicago, Illinois, November 1, 2013. The government shutdown resulted in another month of tightening mortgage spreads and lower rates. Loans are dipping below 5% for longer-term leverage on a more regular basis. Funding sources scramble to identify attractive yields with lower risk profiles, but the dearth of capital leads to tremendous competition as noted by the following. 1. Overall permanent mortgage rates start in the lower 4% range for 10-year funds, and about 1% lower for shorter-term 5-year funds. Such rates are about 0.25% lower than the end of summer. 2. Although overall rates are steady, spreads tighten by about 10 basis points for premier quality assets. 3. More lenders are venturing into non-conventional property types, especially hotels, student housing, self-storage, etc. In many cases, these properties are now being reclassified as conventional, especially for lower leverage financing, which is often as competitive as for conventional assets. 4. As a permanent loan arena is very crowded, more bridge lenders appear in the marketplace, particularly Wall Street and credit companies regularly competing with banks for such debt. 5. Leverage rising for adjustable rate mortgages, and lenders try to provide floors of 4% for 10-year debt on both fixed and floating rate product. 6. Equity funds expanding into single-family home development as housing prices rebound in many parts of the country. 7. Class A, suburban office buildings gain more investor attention for both debt and equity as too many players are crowded out of the multifamily, retail and industrial sectors due to very low yields. According to the Real Estate Capital Institute's Jean Peck notes, borrowers are enjoying a resurgence of lower rates versus a mid-year spike. She suggests, now is as good a time as any to take advantage of low fixed rates and flexible floating rate deals as lenders offer more leverage than in the past. It feels like 2003 to 2005 again.
December 1, 2013 Real Estate Capital Scoreboard December 2013. Chicago, Illinois, December 2, 2013. The stock market hit new highs and treasuries climbed upward, yet mortgage rates held steady with 10-year notes rising by less than 15 BP and 5-year notes nearly unchanged. For the most part, lenders absorbed rate increases by dropping spreads. What's more, mortgage pricing differences between various types of properties and levels within the capital stack continue tightening as evidenced by the following long-term debt pricing summary as indexed over the 10-year treasuries. Low leverage senior debt, 150 to 170 bits per second over treasuries for 65% loan to value or less, with multifamily and credit tenant loans reflecting the lower end of the pricing curve. Lodging loans about 20 bits per second higher and 10% less leverage. Full leverage senior debt, 170 to 220 bits per second for 75% to 80% LTV. 75% applies to most types of commercial properties except for lodging, generally, 65%, and 80% targets multifamily/credit loans. Mezz/preferred equity, 300 to 1,500 bits per second for 5% to 15% additional proceeds, generating a combined 75% to 90% LTV. Overall yield, inclusive of fees, of 7% to 12% for lower leverage and up to 18% for higher leverage, more structured funding leaning towards equity yields. Joint venture/equity, 1,500 to 1,700 bits per second for up to 10% of the total proceeds. Overall yield of 18% or more for higher risk and new construction/rehab deals. Equity multiples of 1.5x to 2x targeted. Pricing heavily weighted on sponsorship, in addition to deal metrics. Underwriting. Since capitalization rates are at record low levels for most types of core and core plus properties, funding sources are turning to debt yields, 8% to 9.5%, and debt service coverage ratios, 1.15x 1.25, as minimum cash flow performance thresholds for senior debt. Mezz, pref equity, JV and equity funds often priced as low as break-even cash flow if projects demonstrate performance upside. Jean Peck, director of the Real Estate Capital Institute suggests, lenders are eager to lend. However, obtaining debt is much less of a problem than finding reasonably priced investments for most borrowers.